Hello and welcome yet again to today's session. And so sorry for the delays, especially from the earlier on. Now, on this session, this will be quite basically a short one. We are going to review basically different investing and trading strategies. And a lot of the time, you'll be looking at me. I'll try as much to also be able to review the differences, especially the on the side when it comes to uh, st- different strategies on the especially under portfolio management. I'll be able to share my screens once in a while and be able to show you this. So on the very first module, some of the things we're going to be looking at is portfolio and risk management. We are also going to look at key differences between day trading and swing trading. Also be able to see scalping, buy and hold. Also see a bit of the understanding technical analysis and indicators, and what it means to actually build a well-balanced portfolio. Now, to start with, let's understand what a portfolio is, and especially I'll be sharing my screen here just to show you how you can be able to quickly understand different types of portfolios. Now, to start with, um, a portfolio basically means you're looking at a set of different cryptocurrencies that basically compose of what you're actually whatever you're trying to is basically a collection of it's a collection of assets. Now, these particular assets, just again, like you can strategically manage your individual investments, you can also strategically manage your portfolio as a whole. So this is a very important part. So a portfolio can actually be either, say, something like real estate, stocks, cryptocurrencies, different types of things. So when it comes to portfolios, anything that you can invest in actually is part of your portfolio. Anything that you are actually holding, may it be cryptocurrencies, is part of your portfolio. So the key difference here is the fact that, for instance, when you're working on a portfolio, there's need for things like being diversified. So you need to first also set your expectations in terms of the type of risk you're looking at. So in most of the cases, for a high risk portfolio, you're looking also at high returns, but also there are some people who are risk averse. So it's important for you to also sort of always try and build a well balanced portfolio. Now, how can you actually do this in terms of building a well-balanced portfolio? Some of the key principles here, again, I'm referencing some of our blogs because it's very important for you to always, I'll try to zoom in just a bit so this text is big enough for us to see. Perfect. Now, when you're building such a portfolio, you also need to define a bit of some other things. There are things like the amount of time you actually want to invest in. This also matters. You could take something passive, more of a hands-off strategy, which is also something you can highlight. Now, before you get into the portfolio, you need to understand things like the investing risks, basically risks associated with building a portfolio. So what are you likely to experience in terms of the investments risks? So I'll just quickly share some of the risks maybe you are likely to experience, starting with market risks, where again, in most of the cases when the market moves, especially uh, basically there's potential loss whenever you're exposed to the market, because markets are not always a win-win situation. In some cases, especially if you make bad bets, this could land you in a bit of trouble. So it's important for us to always ensure that we understand some of the risks involved. Now, the second part is understanding what we call liquidity risk. And liquidity risk is basically this occurs if, for instance, I don't know if a lot of you have seen some of these coins which will print big numbers. Oh, we've made 2000% on a daily. But ideally, you really can't sell your funds because there's liquidity risk. Basically, you can't convert your crypto to actual assets. So that's something called liquidity risk, and it's something we need to specifically highlight. As again, it's one of the challenges that new users, especially new users, may face. Then there's also something we call operational risks. Maybe I could pull up a few of the on the risk management side before we even go to building a well-balanced portfolio. So it's very important to always look through a framework of what you actually expect in terms of the risks you're willing to be taking. So that starts with for you to actually understand the risks, rather to actually manage the risks, you need to understand what type of risks you have. So we'll look at how the process of identifying these particular risks. This again is what we call risk analysis, which helps you determine the scope of risks and their frequency, and of course their severity. Does a specific type of risk mean that it could clear your portfolio? A systemic risk, for instance, where a whole industry comes down crumbling, could it clear your portfolio? These are some of the things you need to highlight before you're looking at it from a different angle. Now, there are four major risk categories in this case. Credit risk, again, this is basically when a party does not honor their contract, or basically a financial obligation, and which will be significantly reduced if traders enter into transactions with big exchanges. So again, Bitget would help you. For instance, trading solely on big exchanges like Bitget would help you avoid this particular credit risk. Liquidation risk, which I described earlier, again, this is the inability for you to exit a position simply because there's no basically the exchange itself is, say, not reliable enough, or you cannot swap one coin to another. So that's something, for instance, Bitget helps. These ones can be mitigated directly from using, for instance, using a good exchange in this particular case. Now, market risks, again, these are mostly driven by several factors. These could be interest rates, the exchange rates, a couple of other things that could drive market risks. But again, these are typically mitigated by having a good exchange. Typically, when but it's not just enough for a good exchange. Research is also very, very important whenever you're doing this. Now, for systemic risks, these are typically what I mentioned, being like the entire industry suffering a particular shock. And this is why it's very important to not just diversify your portfolio in just different cryptocurrencies, but also put your portfolio in other assets outside of cryptocurrencies. So recently, for instance, when you take a look at the past few weeks, we've seen the markets correcting. Now, if someone was invested in other assets which are bringing in regular income, this would be a very good point to actually try and buy different tokens, coins at a cheap level. But if you're not diversified enough, you'll find that you are, in most of the cases, probably you do not have enough funds to try and actually add into the market. The is what we call buying the dip, and then the dip depends, and the drill. So it's very important for you to also not just look at what exchanges, but rather not just look at cryptocurrencies, but also look at different types of investment outside of the crypto world. This is very helpful long term. This is not to say you should not trade cryptocurrencies. It's very important for you to also put a lot of effort when it comes into cryptocurrencies. Now, there are a couple of things you need to consider whenever you are assessing the particular types of risks. One of them being the price volatility. The other one being the general industry health and other related news. If you're trading a specific token and it's highly volatile and you do not have any other options, then it means you're trying to, basically you've already exhausted sort of all the risk you could be taking. So after identifying, say, your high risk investments and the kinds of investments they have, the next step is for you to actually decide how much you actually want to offset this particular risk. And when I say offset, is if you have an extremely high risk investment, you should also have an extremely low risk investment to actually go hand in hand. Some of the options, especially from the low risk end, is your cash equivalents, your notes, your bills, basically your any money sitting in a bank, money market funds, bank accounts, government bonds. All these are low risk investments. And you may ask yourself, why did I say investment on money sitting on a bank? There's a general rule of trading which says not trading is also trading, because if, for instance, I was in the market and at any one point I want to be fully exposed in the market, then it means that there's no one point in a stable portfolio. So it could be up, it could be down, and where there's significant news, especially which moves the market against your positions, in that case, it means you have no much of any place to basically be able to move. So these are some of the things that you need to specifically look through, because it's very important for you to understand these, what type of risks this presents. Now, I will now go to something else. Again, I've not forgotten we have the crypto portfolio to create. I want us to quickly review something here. Different strategies when it comes to actually not just managing risk, but trying to understand the investment strategies. Then we'll come to a point where we'll be able to review different strategies when it comes to, for instance, actually managing your portfolio directly. It's important for you to also ask your questions on the channel, because we'll be able to answer them as fast as we can. Now, let's take a look at something we call day trading versus swing trading, and understand some of these particular analogies. Now, when it comes to day trading and swing trading, if you ever watched say movies about, say, Wall Street, there's a movie I usually like, The Wolf of Wall Street. There's also what do you call it? The Margin Call, I believe, and The Big Shot. These are some of the nicest movies in regard to trading. But if you've ever watched movies about trading and, for instance, Wall Street, you've already been made familiar rather, on what things like day trading is. But movies can be a little, outdated, and with stockbrokers shouting over each other and, furiously on the trading floor. Now, that have already changed, because now we have digital platforms like Bitget, where you are able to execute all your trades in one place. Now, day trading is actually entering and exiting all your trades within the same day. That's basically what day trading is. And this means as a trader, you start your day holding no, if you're trading crypto in this case, no crypto, no stock. If you're trading stocks on the other end, um, and all the purchases you make during the day, you actually sell them before the day ends. So these, for example, if say in the morning I opened a Bitcoin position, a long position, and I closed it anywhere before the day ends, that would typically count as day trading. So now, it's day trading can help can while cryptocurrencies are typically volatile, day trading can also be very interesting because you need to be more connected to the market and understand things like news, the impact of different types of news coming to your end. So that's a very important part. Now, on the other end, we have something called swing trading. So swing trading operates differently. So it has some similarities with day trading, but again, it doesn't work. It works rather on a much longer period of time. So positions usually are held anywhere between a couple of days, a couple of months, and the goal here is to profit from larger swings in price. So your goal as a swing trader in this case is to actually identify assets that could be undervalued and are likely to increase in price. And in this case, you'd purchase these particular assets and sell them when the price goes to profit. Also, the swing traders could also be trading shorts. In other words, where you find assets where you find them to be overvalued, and in this case, we can actually come in and short the markets using Bitget futures to short the markets, and you can be able to actually make significant gains from there. So the goal is to typically hold the position for a very long period of time. So that's something very important when it comes to day trading and swing versus swing trading. Now, I want us to move to the next part where we get to see something called scalping, and I'll try to pull up. I'll try to pull up something right here on the insights. This again an insights post. It's not necessarily actually on this one. Maybe we could just do these. All right. So for scalping, so basically, what does scalping mean? So let's start by understanding, what really usually happens here. So when while for instance, what we've just discussed, day trading takes place over a day, it's possible to actually trade over shorter periods of time, very short time frames. So scalpers try to get to rather game small fluctuations in prices and trade large amounts over minutes or even seconds. I don't know if you've seen cases where markets just simply move extremely fast within a very short period of time. In some cases, these usually scalpers trying to make a buck or two, and we can quickly review what scalpers look like here. So this strategy is where basically different traders and trading systems open and close positions within minutes or even seconds while trying to take advantage of small price movements, and this focus is to actually try and make as many trades as possible within a given period of time. So scalpers actually predominantly use technical analysis to make their trading decisions, and the difference between the price people are selling and the price people are bidding, which is actually known as a spread. When you're selling, you're likely to be paying a certain amount of spread, basically scalpers are using this particular opportunity to be able to make some cash during that, on that particular thing called spread. Now, some investors will purchase an asset at higher price and also sell at a lower price to trade instantly. A scalper tries to offer these particular prices to both of these to both of the investors. In this case, whoever is selling, they're trying to offer them at a slightly higher price, just points. They are just literally making points. So this is also something traders could do, but now these are best used when it's automated. Then my best and long-term strategy, which I call buy and hold. Um, so the buy and hold, as it sounds, is very, very uh, I'll use this to basically understand what hodling is. So this is quite easy. If scalping, for instance, is a bit complicated for you, you could then you maybe you're looking for maybe least time involvement in terms of the investments you're holding. You could just buy and hold. Probably still the best bet for most of these particular strategies. So this strategy is basically buying and holding your asset over a very long period of time, and it's a long-term passive play where you actually purchase an asset and leave it alone regardless of the market conditions. So this is what people call hodling. This is not spelled wrong. It's basically hodling, not hold coin. Sorry, I went to a different uh, but anyway, you understand. So this is basically where you buy and hold those that particular coin. So that's more, and Bitget does help you achieve this by what we call auto invest. I'll quickly go here, which allows you to buy small amounts over a particular period of time. And this is something that helps you in terms of the long-term side. You can be able to get different you can be able to literally uh, earn profits by simply buying small amounts over a long period of time. Now, I'll quickly move to something else where we would take a look at what we call technical analysis. And all this information is actually on the Bitget Academy. So it's very important for you to also be looking through you can see me actually literally searching for all these and just finding things like technical analysis. Now, when it comes to markets, you'll find that traders rely on indicators to actually help them execute their trading strategies. So there are actually many different types of indicators, but then how do you actually know which ones are actually best for you? Now, every trader will, in some case, tell you something different, and some may look at, say, market momentums. Others will filter out market noise and measure different types of volatility. But basically, technical analysis would be your go-to, your go-to type of way to look at it, to look at things. Now, there are 7 assumptions and principles for technical analysis. The first one's basically meaning the market always discounts everything. So in other words, the price of anything will always at some point correct, and you'll be able to get to put crypto or buy something at a significantly lower price than it was. The other assumption is usually that the price always moves in trends. So in other words, if say Bitcoin is moving on a certain trend or a certain trajectory, you're likely to have all your altcoins moving that particular trajectory. It may not match what say the leader in that particular market is doing, but this is also particularly true when you have a large cap asset. There's also the point that history actually repeats itself. So it's not normal to see history repeating itself. Basically, when you look at, for instance, the Bitcoin chart, you'll find that every 4 years there's a certain cycle that you can literally see that this is sort of repeated. So there's always the need for looking at trend continuation, uh, especially when you're evaluating these particular assets. Now, we will quickly take a look at some of the indicators. I won't be covering everything. This is just a quick walkthrough, so it doesn't have much data. So there's something called moving averages. So moving averages are basically an average price which is calculated by doing the sum of historical prices. Now, there are two types of moving averages. One we call the simple moving average, or otherwise called the SMA. So basically, what SMA is used to define support and resistance levels to help traders know when to enter or exit the market. When I say support, I mean the lowest levels that that particular cryptocurrency uh, can go based off its trend, and resistance being the highest that particular trade can go based on the trends. Something else we have is something called the EMA, or the exponential moving average. This is actually more sensitive in terms of the recent changes. So the simple moving average is basically basically the average is calculated and shown on a graph, okay? The exponential one uses a lot of more weight to the past. If, for instance, I'm on a 10-hour, I'm on a 1 day time frame, it puts more weight of the past days as compared to simple moving average, which will just move based on the averages, no matter the previous movement. Now, let's move on to see something very interesting, what we call the relative strength index. This is what I would call a momentum indicator that usually shows whether an asset is either overbought or oversold. Okay, so it does this by measuring the magnitude in terms of the recent price changes, and the data is then displayed as an oscillator that can have a value between 0 and 100. So when the RSI, for instance, crosses the 70 mark, it just sort of the key interpretation there is usually that this particular asset is overbought. If it goes below 30, then it means this particular asset is oversold. So you can read more about these particular indicators. You can see more of the average directional index, ADX, and a couple of other indicators that you can actually be able to find. Now, these are very important. Actually, there was one other indicator I usually like showing, because this is one of the better indicators I usually like, and that's called the Bollinger Bands. So the key purpose here is to provide relative definition of a high and low prices on the market. And when the price of an asset moves closer to what we call the upper band, I'll show you the upper band shortly. It indicates that the asset might be overbought, suggesting potential reversal or a slowdown in the trend. So for Bollinger Bands, okay, this does not have Bollinger Bands. I want us to see, I believe this one, or actually we just could go to the market and we can just see Bollinger Bands. But these are very interesting indicators. So they are always where is could just go to futures right there and then find demo. All right. So indicators on Bitget are always, you can find them on this particular site. So on this particular side, so you could these basically these are your tools to help you make specific decisions. Your indicators can be found here, so I can come in and find what we call Bollinger Bands, something like this, and you could actually go ahead to configure Bollinger your bands to actually, so if you can see right there on this chart, you can see basically what this means is whenever these bands are wide off, it just means the trend sort of is going in the same direction. When they come together or they cross, they just mean the trend is going to see a reversal of whichever direction they are moving. Now, I'll now go back to here where we see a well-balanced crypto portfolio. But before we even go to the well-balanced crypto portfolio, there are a couple of things you need to define, whether you're in it for the long term or short term. Okay, the other part is we only invest money that we are willing to actually completely lose. However, it doesn't mean that you're going to lose it. It's just the thought that I'm not going to be using this. Basically, this is not my money for the next X number of period of time. So something else we need to do is we invest at the speed of our understanding of crypto. So basically take your time for you to understand, to do research and understand what you're investing in. And then finally we invest with the objective of maximizing your gains while potentially limiting your risk. Now let's take a look at right here. So this is basically what would typically happen whenever you are trying to invest. In most of the cases, you want to have your most stable cryptocurrencies being at least 40% of your portfolio, your medium stable being 30%, your low caps 20%, and your degen plays for you being 10%. So these are very, very, for instance, in this case, you can see, for instance, at that 40% allocation on Bitcoin, 30% on Ethereum, 20% on altcoins and mid caps, and 10% on low cap cryptocurrencies. That's a well balanced portfolio because again in this case it doesn't again have to be specifically on cryptocurrencies alone. It can be also mixed, and basically the key differences between a diversified and a concentrated portfolio is that diversified portfolios usually help you reduce your overall risk, and also your gains can offset your losses, and there are actually more opportunities for you when you have a diversified portfolio because again things keep popping up and you can be able to jump on top of them. It leans closer to the market averages return in versus, for instance, for the people who've been trading, especially meme coins, you'll find out that there is a high chance that, for instance, the Bitcoin trend is higher than your potential gains on the meme coin side. Similar case, whenever you're building portfolios, concentrated portfolios may require less time and research. They also may require a great Sorry guys, I was disconnected, power issues here, but we are back. Now, those are key things. It's also important for you to always use portfolio trackers. Good portfolio trackers like CoinGecko can also be very helpful for you because you're able to know, for instance, what is your entry and where do you seem to want to cash out at. Now, uh, with all that said, when you're there are a few reminders I would have for you. You need to determine your risk profile and diversify accordingly. You also need to rebalance if and when needed. You also need to allocate new capital strategically, do your own research, and also invest what you can afford to lose. Now, on the topic of doing your own research, we've actually compiled research strategies on a past webinar, so do ensure to have checked on that. Now, with that said, I'll quickly review some of your comments and questions and be able to maybe answer some of the questions should there be any. Today's sessions was more on the informational side, but should you have any questions, this is your time to actually ask your questions. In the meantime, for those of us who are not following Bitget Africa yet, this is our channel at Bitget Africa Official. If you can see down here, Bitget Africa Official, that's our channel. So do ensure you are actually following us on Telegram and on Twitter at Bitget Africa. All right, let's see if we had any questions or comments. Someone is asking how old am I? Hey bro, I've seen meme coins. I look old, yeah. uh, okay. All right. Okay. You can just see right, left, right. The channel. Okay, sure. Anyway, we will try as much to always bring you some of these things. We are trying as much to always give you some of the most valuable topics. Do ensure to also ask them on Telegram. We'll be able to answer them right there, and also accompany a masterclass or a webinar like this to be able to give you some of these answers right now. That said, it's been an honor to have you all here. Thank you, Sam. Thank you, Kwani. Thank you, Mohammed. Let me do a shout out to everyone, Yusuf, Ransid, all the people who've been able to follow this session. Thank you so much. And we will be able to see you on the next session. Thank you so much and have yourselves a good evening. Bye bye for now.